Hello and welcome to this week's episode of The Capitalist Investor. As always, you have me, Diamond Hands D, and the whole crew, Cool Hand Luke, Tony the Tiger. What's going on, guys?
Yeah.
I'm back alive.
You made it back.
He's alive.
Excellent work. You going out to
excellent work. You're alive.
you going out to New York more often now?
As long as Mark has me out there, yeah.
Awesome.
It's all up to big man, you know, Tony and Mark, right? The big men on the block. But it's actually, as of this podcast being out, I will be out there on Maria the next day. So tomorrow morning, which would be Friday, tune on in.
Nice.
Okay.
Bright and early.
Cool.
Filling in for the big man, Mark.
All right.
Awesome.
I like it.
How's your Lyme disease update? You get that
I
checked out?
haven't been twitching. My eye hasn't been twitching, and my facial movements have still been there, so I think I'm okay.
You know, I hear it's a big problem though.
Let's check.
They were talking about it at the golf course.
Let's check on
Lots of
Luke's
ticks out
health.
there. You got to keep your head on a swivel.
It's big in Maine, I guess. Maine, the New England area. So I guess I got lucky. If I would have camped in Maine, then I probably would have Lyme disease, but I'm good.
All right. Well, there's no transition from that, so we'll just go right into it. Planning corner this week, top retirement tax objectives. And, you know, I think whenever we start talking about financial plans, you know, just talking about it, the more that different, different situations come into play, they all kind of relate to each other. And taxes are a good one because the different choices that you make regarding your distribution strategy, kind of how you saved up into that, all have an effect on you know the outcomes and how much you will be taxed. So yeah, distribution strategy.
Let's just think about it. Like, the IRS does not call you when you mess up your taxes.
Yeah.
They only call you when you underpay them, right?
Yep.
And they'll probably, you do your own taxes and they'll send you a refund, but who knows? Maybe it sparks an audit. Who knows? But at the end of the day, it's on you to make decisions when it comes to your taxes. And then so therefore you have to educate yourself on different strategies. So whether you do taxes on your own, TurboTax, you work with the CPA, well, there's another roadblock in my opinion, because what is that CPA's vision of your taxes, micro or macro? And the micro view is like, I'm going to get you the biggest return this year. The macro view is like, hey, let's do some strategies, pay more taxes this year because it will be worth more in the future, and maybe you pay less taxes in the future is what I could or should be saying. So like Roth conversion strategy, there's a consequence to that. You have to pay tax, right? So that's kind of my thing.
Well, I mean, the environment we're heading into, you won't even need an accountant, or you won't even need
AI.
There won't even be an IRS. It's just we're going to pay all of our money to taxes.
Just pay your fair share.
Yeah, we're all going to be paying our fair share, 100%.
Do you think we'll ever get to the point where we're everyone's just paying a flat tax?
That's the simplest, most.
It's not thousands of pages of tax law. It's here's about 3 sheets of paper, and this is how it works.
The problem is with that is there's always a cause and effect to every change in the tax code. So like you change one small thing, then it's going to slow down business owners, tax deductions in some areas, or it's going to make someone else pay more money and someone less money. So it's like you have to transition that slowly, which would be nice to do if we eventually got there, because I think that would be the best solution to make things less complicated. But the problem with if we go down that path is the government's going to try to push it so much to the point where they're only going to do it as long as it drives more government revenue, taxes. So maybe you'll see a 40% flat tax or something like that. It's not going to be like 10%. It's going to be like 40.
Yeah, and I think the runway would have to be very long. Like, hey, we're doing this in about 5 years, so get your stuff in order, right?
Again,
like, it can't just fix that. You can't just come up with that in September and implement it in January of the next year.
Yeah. Well, again,
come on, let it out.
I hate talking about taxes in general because we ignore the fact of why do we even pay taxes? Like what? We know we have to pay them. but we don't know where it goes. We really don't look that deep into all the different laws that are passed and all that stuff. I mean, the Revolutionary War, I think, was fought over 1% T-tax or 2%.
Mm-hmm.
Now we're paying like 60% when you add everything up to the government.
Well, also think about it. Like, not only do we pay it, like you said, we don't know where it goes. We also can't dictate how it's spent.
Right.
Really?
Does that mean democracy is failing?
Well, you elected those people to be in there to make decisions for you.
Some people elected them in.
So, all right. Well, anyway, let's talk about retirement taxes. Let's just face on what is in front of us now, and that would be, all right. So when you're in retirement, you have to obviously make a paycheck for yourself. So distribution strategy, very important. The next thing is taxes are going up. So does it make sense to do a Roth conversion right now? Because if, when we wake up on January 1st of 2026, taxes are going to be different. Whether, and they're going to probably be more if Joe Biden wins. And I'm sure Trump will make some adjustments because he's going to be inheriting us printing trillions of dollars every 100 days. So something's got to give. So I guess we'll find out. And then the biggest thing is that when you start implementing these strategies for taxes, you got to go back to the drawing board every year because things change. Tax laws may change. Your lifestyle may change for the better or the worse. And also life happens. Hey, I need a new roof. I need a new heater. Like talking thousands or tens of thousands of dollars of things that just pop up. Mm-hmm. Well, if you start taking these distributions from your retirement accounts, it adds to your income and you're going to be taxed more. So a couple of things to think about there. But at the end of the day, working, it's on you to pay the least amount of tax possible now and in the future. So having a plan is one thing. Working with a CPA that is more macro view is another thing as well. Make sure that they have your best interest now and in the future so that we can figure all that stuff out.
Yep. And, I would say, just to add in one last thing, probably one of the more common things I hear from younger people, maybe, 10 years away from retirement, that, maybe it's too early to start planning. I'd say taxes are the number one thing that you have to start planning for as early as possible. Because there's limited amount of things that you can do when you're already retired and the paychecks are already turned off and you're already pulling in income that you need for retirement. So the earlier that you can start planning for your taxes specifically, the better off that you'll be and the lower your tax rate will be in retirement.
Not to toot our youth, but I actually, had a really good conversation with a new client a week ago, and they're 70 years old, and they have an accountant. They've had an accountant for like 20, 30 years. Guy's 80 years old. And one of the reasons they hired us is because they're like, you guys are young. Like, you guys are in your 40s, 30s, and 20s. Like, you guys are young and have new ideas. You're not just the 80-year-old CPA that's like Tony was saying, trying to save the most amount of tax today, not thinking about the future, but maybe not even, listening every single day to what new options you have to try to save on taxes and, financially engineer taxable money to reduce your taxable income for the future. So it was kind of a unique perspective. It's like, if you have a CPA for 30, 40 years, like maybe they aren't keeping up as much as they should because they kind of like just are in the old ways of just, they think they know it all and, they're not trying to adapt and evolve, right? Here, it's like we have to always be evolving, listening, and thinking about all these unique things.
Yeah, that's a big thing. Oh, I mean, the other thing is like a lot of, like you said, like, hey, let's try and figure out tax efficient ways. Well, the Roth IRA is the newest thing on the block, believe it or not, but that comes with a consequence. I always have this conversation with somebody like, Tony, should I do traditional contributions or Roth contributions? And I usually ask, I'm like, well, how much money do you make? Because if you're in the highest tax brackets, you don't get a deduction for a Roth contribution, but you do for a traditional. Yeah. So again, it's not just a cookie cutter answer sometimes. So.
For sure. So, all right. Well, thanks everyone for listening this week. Always keep an eye on your taxes. Hopefully we're making that clear through these podcasts, but a big issue out there definitely for retirees. If you guys have questions, comments, show ideas, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.